Hi everyone, it's John Mitchell, and in this video we're going to look at stakeholders, which are those that have a vested interest in the business. Stakeholders have different interests, so it's important to note that the interests they have within the business will differ, and so a manager needs to take those different interests into consideration when making decisions, because a decision that they make may impact one stakeholder positively, but may impact negatively on another stakeholder. So they need to take all those kind of things into consideration. Stakeholders can come from inside the business, which is what we call the internal environment, or from outside the business, which is what we know as the external environment. Now, there's a few different things we need to know about the stakeholders. One, we need to be able to define what they are. We need to be able to explain their interest in the business. We also need to be able to explain the conflicts between those interests that different stakeholders have. But also, we need to know the corporate social responsibility considerations that a manager needs to take into account when dealing with a particular stakeholder. So in order to do that, we first of all need to know what corporate social responsibility is. And so corporate social responsibility is the continuing commitment of a business to operate in an economically, socially, and environmentally sustainable manner whilst balancing the interests of diverse stakeholders. So while they are making decisions that are going to impact different stakeholders, they need to take those into consideration, but also look at money in terms of profits and things like that. So economically, socially, the impact on their employees, socially, and also their community, as well as their impact on the environment and keeping a sustainable environment. So that's what corporate social responsibility is. It's about sort of going above and beyond the legal obligations that a business has to try and help those three different areas. And those three different areas we know is known as the triple bottom line, where hopefully the triple bottom line is not just impacting the economic bottom line, but also the socially and environmentally impacting positively on those areas as well. And so it's important that businesses consider those issues when dealing with stakeholders. So let's get into the stakeholders. First of all, we have owners or shareholders. If it's a company, we know them as shareholders, remember. So shareholders or owners are those that own part of the company. What is their interest? The shareholders want a return on their investment through capital gains, increase in the value of the business, or improve profits where they actually receive dividends, so receive part of the profits. Depending on the size of the business and the structure, the shareholders may not be involved in the day-to-day operations of the business. They may just put money into the business and then try and receive a return on their investment. Corporate social responsibility considerations. Managers need to be honest and open about the financial reporting, and also about the business's future prospects, so that any shareholders really can make a decision on whether to buy more shares, just hold their shares, or sell their shares, or even prospective owners or shareholders can actually have a really good understanding of what the future prospects of the business are. And some shareholders will only invest in businesses that are socially responsible. So it's important that the manager is making decisions that surround corporate social responsibility. Now, directors are the people that have the responsibility for managing the company's business activities. So the directors develop the strategies and make major business decisions on the future direction of the business. They expect to be well remunerated, so receive money, and also through share options. And the corporate social responsibility considerations, they need to make decisions that consider the social and environmental impact, not just the economic impact, which is going to obviously meet the shareholder expectations. They need to consider that triple bottom line. Managers are those that run the different areas of the business to ensure that the overall business objectives are being achieved. They really implement an overall strategy of the business and implement it. So whatever the direction and the strategy that the directors have come up with, or the CEO has come up with, they then need to ensure that that is implemented. They expect to be involved in decision making and remunerated fairly, and also to make decisions that are going to, I suppose, increase the value of the business. And corporate social responsibility considerations, they expect to work in a business that is ethical and socially responsible, or implementing corporate social responsibility practices, and also make decisions that consider those particular practices. Employees are those that work in the business in exchange for money. They are the ones that really do all the work to achieve the objectives. The managers, manage and lead the employees, but it's the employees that carry out the tasks in order to achieve the overall business objectives. So employees expect fair pay, good conditions, ongoing employment, and in terms of corporate social responsibility, the employees should be fairly paid, not just paid the minimums. So whatever their value is to the business in the industry, they should be paid fairly. in trying to ensure job security, career advancement, training, ensuring they're trained and invested, and all those types of things. They want to carry out tasks that are ethical and socially responsible. So they don't want to be carrying out tasks that they know are going to impact negatively on the environment or the community in which they live in. Customers are those that purchase goods and services from the business. They expect good quality products at fair prices. Maybe some expect really amazing quality for the lowest price possible, but really customers are normally fairly reasonable. They just want good quality products at fair prices and don't want to be ripped off, I suppose. So corporate social responsibility considerations, they need to ensure that the quality of the products adds value to the consumer, that the customer are more aware of the impact that businesses have on the community and the environment these days. And so it's important that the manager is making decisions and the directors and the owners and all those types of people are making decisions and implementing strategies that are considering corporate social responsibility, because the customers are really aware of those things these days. Even things like Australian made, making sure or trying to ensure that the product is Australian made and Australian owned, so that the money is kept within Australia and supporting local employment. Suppliers are those that provide a business with materials and other resources. They expect strong relationships with the business and to be paid on time, and also, what we mean by strong relationships, so that it's an ongoing relationship, so that the business will continue to use the supplier. Businesses, in terms of corporate social responsibility, businesses need to ensure that their suppliers also implement practices that demonstrate corporate social responsibility, so that they're paying their workers fairly, that they have good conditions, that they have fair trade. And even if the suppliers come from overseas, it's important that if their employer expectations and standards aren't as high as what they are in Australia, that's okay, but it still needs to be fair. So also, another consideration is using local suppliers where possible, so that the employment and money is staying within our country. Competitors are those rival businesses that sell similar products in the same market. Businesses need to monitor what their competitors' actions are, so that they can keep up to date and remain competitive. Competitors really expect healthy and fair competition. You could even argue that they expect to increase their market share through fair competition. Corporate social responsibility considerations, fair dealings with competitors, so differentiating your products and not just a competitor comes out with a product and another business just rips it off, for example. Interest groups, some of the common interest groups are those that attempt to influence the business in some way, such as trade unions or consumer groups, and really what they're after are fair dealings with the interest groups and negotiation in good faith when negotiations happen. The government is another one from the external environment, and it's a group, obviously, depending on the level of government, whether it be local, state or federal, that govern a particular area. And really, they expect the business to help the economy and the community and provide employment for the citizens within the area that they govern. So the corporate social responsibility considerations, businesses should implement corporate social responsibility practices to ensure they minimise the impact on the community and also the environment, and also keeping operations within Australia as much as possible to support local employment. So the last thing we need to go through are the conflicts. And so one of the common conflicts that can happen is between employees and shareholders. So let's say the employees, they want fair pay, good working conditions and ongoing employment. And they may demand or request an increase in wages and say that we're not happy with our conditions, working conditions, we're not happy with our wage, we want an increase in that. Now that may be all well and good, and the manager may think, yep, that's fair and reasonable, but what about the shareholders who want a return on their investment? So if more money is going to the employees, that may mean that the shareholders receive less profits, and so there is a conflict between those two particular stakeholders in terms of their interests. And so the manager then needs to make decisions on which way they go with that. They may be able to achieve both and say, well, yes, the employees can receive higher wages, but that can lead to productivity gains or somehow increase shareholder value in some form, and that may be the best option. However, the point I'm trying to make is that there are conflict between these two interests, and the manager needs to consider them when making important decisions. So in summary, the stakeholders are those with a vested interest in the business. They're all the stakeholders that we went through. I know this video was a little bit longer, but there's lots of different stakeholders. And even though this is just one point in the study design, it's important that you are able to define each stakeholder, you know their interests, you know the conflicts between their interests, and you know corporate social responsibility considerations. So that small dot point in your study design turns out to be quite a large one. So for questions, activities, And to find out more about our second exam preparation lectures, then come on over to teachingbubble.com.